Thank you for joining for a Tax Foundation discussion about the immediate economic impact and fiscal response to COVID-19, the coronavirus pandemic. My name is Daniel Bunn, and I am Vice President of Global Projects at the Tax Foundation. Joining me today are Carl Smith, our VP of Federal Tax and Economic Policy, and Jared Walczak, our Director of State Policy. The coronavirus demands urgent solutions, but also careful consideration. How can governments best deliver relief without violating the principles of sound tax policy or necessitating harmful tax increases in the future? What can different levels of government and different countries learn from each other? I'll admit at the beginning of this conversation that none of us are health experts. Our expertise lies in economics and tax policy. So for this discussion, we will focus on those things while recognizing that there are important health policy decisions that are required to address this pandemic. For today, we are going to focus on the immediate economic impact of the pandemic and the tax and spending responses that governments have used. Now, Carl, you've written recently several different articles about the economic impact of the crisis. What in your view, is the short-term economic impact of COVID-19?
Well, so in the short term, there are basically two effects. One is because we're shutting down large parts of the economy, there's generally what economists call a supply side effect, or there's a reduction in the available stuff that's out there. With that comes unemployment and business closures for people who were forced to shut down. So people who were simply forced to shut down because they're non-essential businesses. A secondary sort of impact of this shutdown is that those people have less money to pay their bills, to finance things. They're businesses which need to sort of keep their rent going or keep their other expenses going. And so there's a second part that we're sort of in now, which is a lack of cash flow that comes through to households and businesses. And this sort of threatens to sort of undermine the sort of financial security of the businesses, of banks that depend on those payments, of households that might, otherwise face foreclosure, or renters that might be kicked out of their home. And so there's a middle phase that we're entering, where the primary sort of economic impact is this sort of lack of cash flow that businesses and consumers are facing.
And how does that differ from what we expect to see in the long term?
So in the long run, once the pandemic is lifted, the problem that we'll face is that because people went through this, because of both the uncertainty that they faced going through this, and because they lost cash flow, some businesses had to close down. We'll see this unemployment sort of carry on in the economy and actually sort of build on itself, because people won't have money to spend. And so even the businesses that are trying to reopen won't have as many customers as they think they had. They won't be able to keep their payroll as long. They'll have to lay people off. And then we get sort of a traditional recession where we build on top of the initial shock, because people have less money to spend. And so other businesses go down that would have otherwise stayed in place. So
go ahead.
Yeah, so the first part is a strict sort of cash flow sort of shock, and then the second is sort of a cascading wave that moves across the economy.
So I guess looking at those different effects, policymakers might be thinking about different tools they would want to deploy in the short versus the long term, or ways that decisions in the short term can help the recovery in the long term. Jared, I'm interested in your thoughts on what tax policy can do to combat this kind of short-term fallout.
Yeah, clearly the single most important priority right now is outside of tax policy. It's addressing the public health crisis, testing, treatment, vaccines. But policy responses can and have to proceed across multiple different lines right now. And tax policy is an important component of the economic response. And that comes in a lot of flavors, and it's at multiple levels of government. So refundable tax credits structured as rebates can help Americans meet their immediate needs. Payroll tax credits can help employers extend paid family and sick leave, can help businesses keep workers on payroll. Reforms to state unemployment insurance tax systems can help ensure that small businesses don't see their tax burden spike at a time when they're struggling to stay afloat. Changes to business tax provisions, like those on net operating losses and the net interest deduction, can help provide businesses with much needed liquidity, particularly if they find it necessary to take on more debt during a crisis. And of course, as we've seen in almost every state, extending tax filing and payment deadlines can provide taxpayers with both a temporary financial buffer and leave them with one less thing to worry about during a crisis.
Yeah, so these policies are all difficult and they need to be timely, but it is helpful to have a few principles to drive those decisions. And one of the things that we've been having conversations about a lot recently is how you design principles that can help policymakers in making these decisions in the near term in the midst of the economic situation that Carl described and the policy decisions that Jared mentioned. It's worth understanding that tax policy used to address the economic impact should follow some basic principles, especially that the temporary economic crisis should be met with temporary relief, and that temporary relief should be targeted to the crisis at hand. This isn't a time for a grab bag of policies. It's providing broad relief where necessary and targeted relief connected to the crisis. And tax relief measures should be in keeping with good long-term policy. And that's one of the things that we've seen in some countries around the world as they're gearing towards better tax policy for the crisis that could be better tax policy for the longer term. We'll talk about these principles more as we discuss what policies are being used to provide economic relief in the short term. And as we move into the policy space, Carl, last week, Congress passed and the president signed into law some pretty significant legislation, the CARES Act. Could you talk through the key tax changes in the CARES Act and how they will impact individuals and businesses?
Yeah, so they're basically four big parts of the CARES Act. The first is what we call the tax rebate, which gives $1,200 to tax filers who have single filers who have more than $98,000 in income, or sorry, less than $98,000 in income, or joint filers who have less than $198,000 in income. After that, it's phased out. So it's $1,200 for a single person, $2,400 for a couple. It's also $500 for each child, and it's phased out again for people making more than $96,000 as single filers and $198,000 as joint filers. So that provision in the tax code is designed to provide the type of sort of broad-based relief that Daniel was talking about. And in particular, because the pandemic has effects across the economy, it's difficult to know who's going to be put out of work or who's going to lose income. And so a sort of blanket check, going out to people, it provides a little bit of liquidity, or what I call cash flow, to people who might be struggling. And for a lot of people, it seems like that's not very much money. $2,000 is, in a city like New York or DC is, not much more than people's mortgage. But for people who are lower income, that's actually a significant portion of their income. And so for the people who are most vulnerable, those people will see a significant boost in their cash flow. The second thing to sort of maintain cash flow is a payroll protection plan, which is going to be administered to the Small Business Association. And the way that works is for businesses with less than 500 people. If they keep everyone on payroll, or almost everyone on payroll, 90% throughout the entire crisis, they can receive loans to cover 2.5 times their payroll, and they can get those loans forgiven if they're able to withstand the entire crisis without laying anybody off. And so the hope there is that we won't have masses of people spilling out onto unemployment, or that we will have people, but we'll have fewer people spilling out into unemployment, that connections, especially within small businesses, won't be broken down, that employers will have a workforce ready to go when the crisis is over. The third provision is a big expansion of unemployment insurance. So on top of normal unemployment insurance, the federal government is adding $600 a week. That amounts to a pay of $15 an hour, 40 hours a week. So that's like a substantial increase in unemployment insurance. The goal there was to do as much relief targeted to people who lost their income as possible. There was some discussion about that, about whether or not it should be capped at the maximum amount that someone earned before, because some people were going to be earning less than $15 a week before this, and now they're getting that, or sorry, $15 an hour before this, and now they're getting that $600 a week plus whatever normal unemployment insurance they would have gotten. So it's going to be a lot more than they were earning. The difficulty, or the counter argument to that, was that it was going to be difficult to implement how much people were earning on total in a really quick fashion. And so Congress came up with a number that they thought would insulate most taxpayers from that. There may be some economic fallout from that we can talk about later, but that was the goal of that plan. And the last bit is to give $450 billion to the Federal Reserve to use as a buffer for $4 trillion in lending. And so the biggest sort of lending program, the lending program that's going to go out to most businesses that are not small businesses, less than 500 employees, is Federal Reserve lending. They'll get loans, or they'll get their corporate bonds bought by the Federal Reserve, but they're not eligible for a grant. So only small businesses are eligible for a grant. So all the money that big businesses get, they'll be paid back. And the reason the 450 goes to the Fed is because the Fed is not designed to make risky loans. It's designed to lend to banks and other really secure institutions. And so the 450 covers them in case some businesses go out of business and can't repay.
That's really interesting, and I think there are some other provisions in the CARES Act that also affect businesses: net operating loss expansions, expansion of interest deductions that probably will provide some of that liquidity as well. But I'm interested in the rebate program. One of the things that has been talked about a lot over the last month or so is how fast these checks can get out the door and how effective they would be. How have large rebate programs worked in the past?
So the rebate programs we've had in the past, we had we had two under President Bush, so one in 2001 and then an early one in 2008. Both of those were checks that were sent out. Economists sort of debate, how much good they did. The checks were roughly on the size of, $1,000 in, I think, in the first instance, and around $800 in the second instance. Our studies show that a significant number of the people sort of saved that money, or they used it to pay down debt that they had. And so those stimulus checks didn't have the effect of sort of expanding the economy. That's a little bit different than what we're facing now, because we know that people are going to have cash flow shortages. We know that they're out of money. And so we're not really trying to get them to go out and spend it. We're just trying to make sure that they have a buffer to keep themselves afloat over this period.
Yeah, it's more relief rather than stimulus,
Right.
like you've seen in the past. Maybe there will be a time to shift that conversation, but certainly right now, it's a focus on relief. Jared, you've been following policy developments at the state level. What have the states been doing in response? Carl mentioned this unemployment insurance expansion. I'm sure there's a connection to state policy there. But what are states doing, and what should they be doing?
They're starting to make a few responses, not as rapidly in most cases as the federal government has done. However, and this is very quick by state standards, all but 3 states with individual income taxes have extended their tax filing and their tax payment deadlines to July 15th, which follows the new federal standard for this year. Those 3 states that are holdouts are Idaho, Mississippi, and Virginia. And Virginia is the biggest holdout here. They normally have a May 1st filing deadline. They've actually kept that filing deadline. They've postponed the payment deadline 1 month to June 1st. But if you don't file by May 1st, you start to accrue interest immediately. You have a waiver of the additional penalties for late payment until June 1st, but you're starting to pay more the moment you get past that May 1st threshold. And I think a lot of people don't realize that, but those 3 states have yet to act, or at least have not acted as other states have. But most states have done something to address this because they don't want people going to their tax preparers right now. They don't want people worrying about tracking down receipts and documents. And also, there's a bit of a financial buffer associated with being able to delay both your filing and your payment for a couple more months. Other states are taking a variety of actions. New Jersey, I don't usually say New Jersey's taking a lead on something really good on tax policy, but New Jersey has taken a lead in ensuring that employees who are working from home don't trigger new tax liability for their businesses by giving that business taxable nexus in additional states. We don't need to go into all the details there, but the basic premise here is that if you have a business that's just selling into a state and doesn't have people there, doesn't have property there, they don't always owe taxes to that state. But the moment you have payroll there, which means even one employee who's now working from home in that state, they could have that nexus attached and maybe pay a lot of taxes to that state, certainly have new obligations and filing requirements there. New Jersey has said if the only reason that person is there is because they're working from home during this crisis, we're not counting that for nexus purposes. Other states really need to be following along in that same vein. Some states are beginning to adjust beginning that work on their budget to adjust and account for the change in revenues. And they know that the sooner they act, the better positioned they'll be to avoid the deepest cuts and greater tax increases later. States also need to be flexible on the timing of other tax payments where possible. They're doing this for income taxes, like I said, but it can be important for some business taxes too, especially those like business license taxes or capital stock taxes that aren't really based on revenue flows or an ability to pay. So a business could be functionally shuttered, doing nothing, but still have significant tax liability because of the value of their assets or some other characteristic unrelated to their revenues or net income. And of course, states do need to start thinking about how to structure their unemployment insurance taxes now, maybe revising them to ensure that they don't stand in the way of keeping businesses open and ready to hire back laid off workers once the health crisis has ended. And I think that is a really important discussion to have. How do you make UI work for both the many recipients, the new beneficiaries we have now, and also for the businesses that pay the taxes to fund that program?
Yeah, I think the unemployment question is going to be a huge one, not only for state budgets, as you mentioned, but for the economy as a whole. Today, there were more numbers out on the unemployment insurance claims, just staggering numbers. And obviously, these are folks who are not only struggling economically, but there are real stresses out there right now due to the pandemic. Around the world, on policy issues that I work on and focus on in other countries, countries are doing similar things that you see in the state and at the federal level in the US. Some have been more prepared for this sort of crisis than others, and that's partially due to their the structure of their social safety nets or their tax system. So in Germany, you have a program similar to what the US is trying to do with the CARES Act legislation, but the program is effectively designed for businesses that are expecting to reduce work hours for their employees, either because they're, as Carl mentioned, not essential businesses, or because of the lack in demand right now. Businesses can reduce working hours for their employees, and then the government steps in and covers a portion of those reduced hours, those reduced wages. In some cases, businesses will be reducing those hours to zero, but it's a program that's designed to kind of offset this type of crisis, and it's something that was successful in Germany and a few other countries that have had a similar program that they implemented pretty strongly during the financial crisis as well. Germany expanded that specifically for this crisis. There are plenty of countries that are delaying tax payments, and especially with respect to value-added taxes, the sales taxes that countries have outside the US. These value-added taxes come with a system oftentimes of refunds for different businesses depending on where you are in the production cycle. And countries are speeding up those refunds, and in some cases allowing refunds for previous tax paid, and then you would pay that tax back at a later date. And countries are also adding in new loss provisions for businesses. In Australia, part of the response has been to expand expensing provisions for businesses. Like I mentioned earlier, tax relief should be in keeping with long-term economic policy, good long-term policy. At some point, we will see an economic recovery, and provisions like expanded deductions for new investments will be valuable to that recovery. In a country like Norway that has a different structure of its tax system than the US, we've seen how the crisis is highlighting some of the weaknesses in that tax system, particularly the wealth tax. The wealth tax could create challenges for family-owned businesses during a crisis like this. So if you are subject to the wealth tax and you own your own business, and part of your business's assets or what your wealth tax liability is based off of, in general, you might be taking dividends out of that business to pay your wealth tax payments. And in a time like this, you don't necessarily want to be taking extra cash out of your business. So the government has postponed wealth tax payments, and it's probably a good time to evaluate whether even having a wealth tax makes economic sense given the added pressure during downturns. Now, one policy that has come out of Italy allows banks to basically trade future deductions for current tax credits. Instead of deducting some losses in the future, some banks can take the value of those losses as a tax credit and even a refundable tax credit to help them weather the crisis. It's basically a trade against the future, both on the bank side for their deductions and on the government side from a tax revenue perspective. These different policies are obviously developing, and countries are figuring out new ways to respond to the crisis, not only with traditional tax policy, but also with trade and tariff policies, reducing tariffs on medical equipment and things like that. And these countries are figuring out other ways to address the crisis, and I'm sure the US will be as well. Carl, as we think about the future of the US response to this crisis, there's talk of phase 4 or some other legislation to address the pandemic. I'd be interested to hear what you think the next phase of responses in the US could and should look like.
Well, those are actually probably somewhat different. What they could look like is the kind of grab bag that Daniel was talking about before. So, like, I think one of the most troubling provisions that came out was pushed by Nancy Pelosi to remove the cap on state and local tax deductions that they were promoting as a potential way to help people who were struggling from the coronavirus. The problem there is that it's not very well targeted at people who are struggling. Almost everyone who takes that deduction is upper income. And at the same time, it's bad tax policy. It erodes the base. And we understand, or we know, that people who are pushing that are doing it because they want to eventually get rid of the cap and move back to where we were before the Tax Cuts and Jobs Act. So I think there's fear that, like, a phase 4 could include a lot of things like that. Something that people are talking about that I think I agree with more is expanding the small business provisions. So it looks like the amount of money they put in to start with was about $350 billion. It's probably not going to cut it. It's probably not going to be enough to provide relief for all the small businesses that are in trouble. As Daniel said, we had staggering unemployment numbers come in the United States. And so this week, 6 million people applied for unemployment insurance. The week before, 3 million people applied for unemployment insurance. So together, that takes us to about 9 million people who, in the last 2 weeks, have applied. In the Great Recession, or after the financial crisis, it took us about 3 or 4 months to reach that level. So in 2 weeks, we've done 3 or 4 months of the Great Recession. And so the small business provisions are probably going to, and we're not done yet. There'll be more weeks. And so the small business provisions will probably have to be expanded in the near term. And so I think providing credit to businesses in the near term is going to be the major step that we have going forward. I don't know if there'll be something done to adjust unemployment benefits. So a side effect, I mean, one that, economists sort of easily expected, was the $600 boost across the board. While it did provide a lot of relief to people, it also provides an encouragement, not to work. And this can happen for essential businesses too. And so it's not really even that, like, people would leave work to get on unemployment, but you're faced with employers who know that if they lay their workers off, they'll actually be better off than if they keep them on payroll. And so that provides a really strong incentive for them to say, well, look, I mean, this is a crisis. My workers are hurting. If I keep them on payroll, I actually can't pay them as much as they could be making on unemployment. And so, I might as well put them on unemployment. A second, perhaps even more dramatic side effect is small businesses, in order to qualify for the loans and then have those loans forgiven, they have to keep people on payroll the entire time. Well, some have already laid people off. The bill anticipated that, and so it said, okay, you have I think about 30 days or so to hire those people back, and then it'll still count as you having employed them the entire time. But because they're earning more now on unemployment insurance than they were at their job, it's hard to get them back. So some small businesses are going to be struggling for that. So I think, and I've argued, that Congress should think about some sort of fix to that part as a next sort of phase in this crisis. But key is going to be the sort of small business liquidity going forward, because small businesses are who are getting hit the hardest. Major corporations are getting hit, but the amount of money that was provided to the Fed and actually the speed at which the Fed is able to do those loans, I think, will take care of them. Um, After the crisis, finishes, I think some of the things that Daniel mentioned are going to be important. And so normally after we have a recession, or when we have a recession, the Federal Reserve lowers interest rates. Lowering interest rates encourages investment in new businesses, it encourages people to buy houses, it encourages any type of sort of long-term purchase. But interest rates have already been lowered to zero. They can't go any further. And so we'd have to think about another way to sort of incentivize investment, because investment is the most volatile part of the business cycle. And if you can spark investment, that's what sort of turns the corner and allows the economy to start going back up. And so tax policy, perhaps like full expensing of equipment, or other policies that encourage investment, make it cheaper to invest, are probably going to be what's necessary after we're finished with the pandemic.
Yeah, that's really interesting. Thinking about how we get back on a path to growth, because one of the challenges that you have to be thinking about is the long-term debt and deficit impact, and what it looks like from a growth perspective for us to be able to grow ourselves, to be able to kind of afford this new fiscal burden. And talking about fiscal burdens, I think one of the interesting things about that unemployment insurance expansion, other than those incentives you described, Carl, is the burden on state finances. And Jared, I know you've been tracking some of this. What should states and the federal government be doing to prepare for that big fiscal burden of these unemployment insurance claims?
The real challenge is that what states need to be doing to prepare is what they should have been doing years ago, and many of them haven't, because now we have reached this crisis. As Carl mentioned, over 8.7 million people filed for unemployment compensation benefits in a 2-week period. Those that have joined the rolls in the last 2 weeks represent 81% of everyone in the unemployment compensation system right now. We look at some of the high watermarks we're hitting. Unemployment compensation claims a week ago represented 3.77% of the entire UI eligible workforce and benefit recipient pool. The high watermark in the Great Recession was 0.68%. The high watermark ever, at least since we've recorded these statistics, was 1.36%. Over 5%, I think 5.6% of the civilian labor force has either applied for or is already receiving benefits. That's higher than the Great Recession peak of 4.8%. Of course, that was a recession that ran for years. And the hope, of course, is the recovery could be quicker, which makes a difference on ability to pay out claims. But we are higher than that Great Recession peak already after 2 weeks. And states are completely unprepared for this onslaught. Just based on those who have already applied for unemployment compensation, California's trust fund would be exhausted in about 6 weeks. And New York would take about 10 weeks. And there are a lot of other states that are in similarly bad shape. So not only,
just to pause for a second, what happens when those trust funds run out? Do they need support from the federal government? What options do they have?
Yeah, they go to the federal government. And if they haven't done this in the past or haven't done it for a long time, they get favorable terms. They can pay it back without interest. They have a longer period to pay that. Based on their history, and based on how quickly they pay this back, interest can start to accrue. And also, eventually, although not in the short term, businesses in those states that have had to borrow will face higher federal rates to compensate the federal government and its trust funds for the fact that the state did not fully prepare. So in 6 weeks or 10 weeks or relatively soon, some of these states are going to be turning to federal loans. And not only are they going to take out those loans and have to pay more later and have their businesses pay more to the federal government later, but even more quickly, their own businesses will pay more to them because they're about to dramatically ratchet up the unemployment insurance taxes on many of these struggling businesses. And this is really the way UI taxes are designed. Businesses pay higher rates when they have a history of laying off employees, and it kind of makes sense. I mean, it's a social insurance program, and those contributing more to unemployment ought to contribute more to the funds that help pay for those benefits. But right now, we're in a unique situation. Businesses are being told they need to close for purposes of public health. And then they're forced to pay higher taxes if they can't keep employees on when their doors are closed. Burdens that will actually make it harder for them to survive, to rehire and bring them back those employees when the crisis is over. And then even worse than that, perhaps, when these state trust funds get low, many states impose a surtax on all employers, regardless of their employment history. Even those businesses that have retained every single employee could face an additional surtax on their unemployment insurance taxes because the trust fund itself needs to be replenished. Now, because states are going to have to go deeply into debt, with the federal government to pay out these claims, and also because we could even see additional federal relief trying to assist with this. In the process, I think states should make temporary adjustments to their UI tax systems to ensure that they aren't nickeling and diming the smaller businesses that are struggling to stay afloat. We certainly need to fund these benefits because these benefits are deeply important and need to be paid out. We also need to make sure that as many of those businesses as possible are able to hire back their employees when the health crisis is over.
Yeah, I think those are all very important things to consider, and I think it links back to what Carl was talking about as far as things that we might see in a next package or things that should be in the next response from the federal level. I think it's interesting, Carl, as you mentioned these things, and we saw this about a week and a half ago. These things can become everyone's favorite goodie bag or a Christmas tree, as they like to say, of all these different unrelated provisions. And it's tough to get policymakers to focus on targeted and timely relief and make sure that the policies are designed so that the crisis isn't as long lasting or as deep. I think it's pretty clear that this type of crisis is unique. So I think it's understandable that some of our systems aren't necessarily built to deal with it, but it's also a challenge for policymakers to be able to think creatively and be disciplined in the way that they're responding to the crisis. Carl, I think it's worth mentioning also that there's some sort of infrastructure package idea out there. I'd be interested to see what you think on that infrastructure package, or whether that should be in a phase 4 package as well.
Yeah, so I think the president is primarily who's promoting that right now. I'm not sure how much other support has gotten from Congress. I'll say this: part of the president's logic makes sense. So one of the arguments that he's making is that we're facing very low interest rates right now. 0% interest is essentially what the federal government pays on short-term loans on T-bills. And so we should take the opportunity to borrow money and use that to sort of rebuild the country. That might make some sense once we're on the other side of the crisis. What doesn't make sense is putting that in a phase 4 while we're still in the crisis, because number one, it takes a long time to get these projects going, and so it's not going to provide any sort of relief. But number two, on top of that, the types of jobs that you would want them to do are the non-essential jobs that we don't want people doing because of the public health crisis. And so an infrastructure package as part of how to deal with the current phase we're in doesn't make a lot of sense. Perhaps if there are good projects, and this is the other thing, people just throw out numbers like $2 trillion what the president threw out. That's not gone through any sort of cost benefit analysis. But if there are projects that would pass cost benefit analysis, the president is right that interest rates are low, and so after the crisis is done, it might be intelligent to go on to those. But it's not really an appropriate response for where we are right now.
Well, we clearly have some time before we see things turn around. Hopefully, less time than we might expect. But thank you, Carl and Jared, for your insights, and thank you to anyone who joined us for the discussion. If you'd like to stay up to date, you can find resources on state, federal, and global responses to the crisis on taxfoundation.org. Jared also has a tracker following unemployment insurance claims, and it looks at where states are in their relative finances for funding those claims. And you can subscribe to updates at taxfoundation.org/subscribe. Thank you so much for your time, and we hope you all stay healthy.